Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. And on today's Adam Live, new SEP and Solo 401k Roth contribution rules that you absolutely need to know. And this is all based off Secure Act 2.0, which was signed into law by President Biden in December 29, 2022. And I did a bunch of videos, podcasts, blogs on Secure Act 2.0. It's about 90 retirement related provisions, over 400 pages. But I want to focus specifically on section 601 and 604, talking about Roth options for SEPs and solos in the case of employer contributions. So we know that a SEP IRA is a profit sharing plan, right? You can put 20% of your Schedule C or sole proprietor Schedule C amount up to 66,000 and that needs to be in pre-tax. Okay. And the employer profit sharing, whether it's a SEP or a solo K, it's 20% sole proprietor, single member LC, and 25% if you're a W-2, right? C Corp, S Corp, partnership, guaranteed payment. And the max is the 66 or 735 if you're over 50. Now, in the case of a SEP, it's just a pure profit sharing plan. And that always has to be in pre-tax, meaning the employee gets the money without tax, the employer gets a deduction, and then ultimately when the employee takes the money out, he or she would pay tax and a penalty if they're under the age of 59 and a half. In the case of a solo K, we know there's two components, right? There's the employee deferral, which could be done in pre-tax or Roth. For 2022, that's 22,000. Sorry, for 2023, that's where we're at right now. It's 22,500 or 30,000 if you're over 50. And that could be done in pre-tax or Roth, depending on your plan docs. And prior to the Secure Act 2.0, prior to 2023, the employer contributions must have been done in pre-tax, just like a SEP. Okay, so section 601 and 604 changed things for the better. And they basically said this: now, starting in 2023, yes, 2023, you can make employer contributions, whether it's 20% if you're a sole proprietor or single member LC, or 25% if you are a W-2, C Corp, S Corp, or partnership, in Roth, as well as pre-tax. So that brings in to bear a number of questions. And unfortunately, the Secure Act 2.0 was pretty much in depth, but section 601 and 604 did not cover all the rules. So there's going to be a need for further IRS guidance. But this is what we can gather as of today. The contributions in Roth made by the employer will still be tax deductible to the employer. So whether the employer does a pre-tax contribution of up to 20% or 25% for either a SEP or a solo K, the employer still gets that tax deduction, which is great. The question is, what happens to the employee, to the SEP participant, to the solo K participant? Do they have to recognize the income since it's after tax? And the answer is, unfortunately, yeah. Because if not, it would be a unbelievable tax avoidance strategy, right? An employer would get a tax deduction for making the contribution. The employee would never recognize the income. And then once they reach the age of 59 and a half and the account's been open 5 years, they would just be able to pull out all the income tax for it. So that would be a loss to the government because they would give the business a deduction and then the employee would get free money. Unfortunately, things don't always work out as well, especially when it comes to tax and the IRS. So this is how the rules are going to work: is if the employee requests, and again, the employer is just an option. The employer doesn't have to; it's an option. So if the employer elects and agrees with the employee, and the employee elects to get a Roth, SEP, or solo K contribution, the employer will still get a deduction, but the employee will have to recognize income. It's probably going to appear on a W-2, probably like a box one, maybe a 1099-R. We're not really sure. That's kind of the guidance we're going to need. Is it going to count for FICA and Medicare taxes, right? I don't know. It's going to be deemed compensation. Probably not. May need to be greater withholding on the case of the employer for taxes. This is still uncertain. But what we could pretty much be certain of is the employer will get the deduction and the employee will have to recognize the income if they elect Roth, right? If they elected pre-tax, they don't recognize the income because they'll recognize the income when they pull the money out down the road. The employer still gets the deduction for both pre-tax or Roth, although for the Roth, they'll have to recognize the income today. Um, One other thing is the contributions are vested immediately, right? If you pay tax, they're obviously vested. And you generally the 5-year rule and the 59 and a half will apply as well. So it's going to be interesting. The one advantage this does has is it allows the employee to kind of time income and tax, right? In the case of a pre-tax, you can't time it. You basically are like, okay, I'm getting the money now as part of the SEP or solo contribution on the employer side. But when I pull it out, I have to pay tax. Here, the employee is going to be able to time the tax and basically say, okay, maybe I want to pay the tax today, right? Maybe I have losses or a lot of charity, or my spouse has losses that I can use to offset the income. And this is a great year to recognize the income. But at least they have the option, which is valuable. It would be obviously a lot more valuable if the income would just be free, right? The employer gets a deduction and the employee would just get free money. But yeah, as I mentioned, it's just too perfect. It can't work that way. It's not just a tax neutral, it's a tax loss to the IRS because they're getting the employer the deduction and then they're giving the employee free money. So obviously it just can't work that way. So again, it just started in January. Some stuff's still in the air. What's the procedures? Is this going to be a 1099? Is it going to be reported on a W-2? How's it going to impact? Is it going to be treated as compensation? How will it impact with FICA, withholding taxes? How is it going to impact other sources? And number two, this is another question this brings to bear. Do these Roth contributions impact Roth, especially in the SEP IRA world? Does this impact the amount of Roth IRA contributions you make? So we know in 2023 you can put in 6,500 or 7,500 if you're over 50. Now, if your employer gives you 7,500 as part of the employer contribution, does that impact the ability for you to put in the 65 or 75? Does that count against it? It shouldn't, although it seems the way Section 601 was drafted, it could. So again, that's something there is some uncertainty, and we're going to have to wait for further IRS guidance. It should come this year, but again, Secure Act 2.0 just at least these provisions just became active in 2023. So I think there is some more guidance to be had. But those are the three areas where we still need guidance. Is again, how are you reporting this? How are you electing this? It's going to be a special form. Is it like an email to your employer? We know it's optional by the employer. How does the employer report it? 1099 or W-2? Does it impact FICA and Medicare taxes? Is there a requirement for additional withholding? Is it treated as compensation? And then ultimately, if you do get these contributions of, let's say, anywhere from $1 to whatever it is, will that impact the amount of Roth IRA contributions you could do? Because this is a SEP Roth. Probably not, it shouldn't, but as I mentioned, Section 601 seems to suggest it could. The easy way to think about this, if you're just trying to understand it big picture, is it's basically doing a Roth conversion, right? Before 2023, you were able to convert your SEP to Roth or your solo K employer contributions to Roth. You just had to pay the tax on what you converted. So essentially, by electing Roth, you're just skipping the conversion process and you're just paying tax on what you get now. Kind of like a conversion, but without doing the conversion. So this is part of the overall theme that's been going on for the last several years of the IRS and Congress to push people into Roth. Why? Again, Roths are after tax, meaning you do not get a tax deduction. And even though ultimately down the road, Roths are more harmful, you can argue, to the government, because so long as you're over 59 and a half and the Roth's been open at least 5 years, all the Roth distributions would be tax-free, meaning the IRS would not have a revenue stream from those distributions, whereas pre-tax funds that are pulled out are subject to income tax. So by pushing people Roth, they're hurting the ability of Treasury to generate tax revenue in the future. But as I keep mentioning, over the last several years, if you're watching my videos, listening to my podcasts, reading my blogs, governments only think budget. They think 4 to 8 year cycles. They don't really care what happens in the next 20, 30, or 40 years, which is a good tax planning tool for us, but brings to bear what's going to happen to the government if they're pushing everyone to Roth. There's going to be less tax revenue to collect in the future, since we're going to have Roth accounts that are after tax and should be sheltered from tax. So this is just part of that theme of pushing more and more funds to Roth, why current deductions reduce the amount of tax the government collects, and less tax money they collect, less money they have to spend. And, governments love to spend money. So they want to protect their ability to spend. And by one way of doing it is by limiting deductions. So that's it. I wanted to focus on this. I feel like there has not been enough attention focused on SEP Roth options and 401k Roth options. There's hundreds of millions of taxpayers that have access to 401ks, and you can aggregate SEPs in there as well. Even though solo Ks are more popular retirement plan for the self-employed, but now the Roth option on the SEP at least adds a little bit of value to the SEP. There still is issues with the fact that the solo has an employee deferral. There's also an exemption from UBIT for real estate acquisition indebtedness that doesn't apply to SEPs. A little bit asset creditor protection, a loan. The solo is still a better plan than the SEP, but having the Roth option on the employer side, adds a little value to the SEP, although the solo gets that same advantage. So be on the lookout, whether you have a solo plan, whether you work for a large company. You may want to talk to your plan administrator, human resource department, whoever takes care of your plan, to see if that's an option. But just remember, if you do elect to have employer contributions, assuming your company makes employer contributions, if you do elect to have them in Roth, you will have to pay income tax on the amount that you receive. This is not a safe harbor match, and obviously this is not employee deferrals. Employee deferrals you make, which could be pre-tax or Roth, they're after tax. You are paying tax on the income. You're just pulling the money after tax, putting it into the plan. SEP Roth is kind of the same idea. Just think of it as the company giving you the money, and you just putting it into the plan. So the company gets a deduction, but you're going to have to take into income, because without doing that, the government would have a loss, because they would offer a deduction to the employer without a corresponding tax paid by anyone. So that's it. Just wanted to put this in focus. Since so many of you have access to 401ks and SEPs. This is going to be a bigger issue for SEPs and solo Ks. Most people that have access to 401ks, whether you work small, mid-sized, large cap companies, generally those companies don't do profit sharings. They'll do allow you to have employee deferrals, and then they'll do maybe a safe harbor match or a small profit sharing, maybe under 5%. So it's not a huge change for regular folks that have access to 401ks at their employer. But if you are self-employed or you have a SEP IRA, this is a game changer. You're now able to do SEPs all the way in a SEP IRA to $66,000. You have to obviously have enough W-2 or Schedule C income to get there, but you essentially can do it all in Roth. Yes, before pre-23, you just could have converted it, which is kind of the same thing. But some people, when this provision was released, some people thought that it would be an amazing tax benefit where you get the money free and the employer gets the deduction, but it's not going to work this way. There's also a question whether this applies for 22 contributions. It's unclear. If so, you can still make 22 SEP and solo employer contributions up until the company files its 22 return, including extension. So if you have it could be October 15th, could be September 15th. And it's unclear. Maybe we'll get guidance. Some folks take the position that since it's a provision that starts in 23, it should apply to 22 contributions made in 23. But as I mentioned, it's somewhat unclear. But the tax bite is the big issue to remember. It's not just free money in your pocket that vests immediately that you can pull out tax free after 59 and a half and 5 years. It's money you're going to have to pay tax on. But at least now you have the flexibility and option to time when you're going to pay the tax, whether you do it today or whether you do it like the rules were in effect prior, before you reach the age of 59. or after 59 and a half, or at some later point. But at least now you have the option. It's a good provision. It's not a game changer just because you could always done a conversion if you really want to do Roth and kind of get to the same position anyways. From the employer side, it doesn't matter because they're getting the deduction. So it's not something that's a total game changer, but it's interesting. It's something that is going to impact millions of Americans. So it's just something I thought would be a good topic for a video since it's really not getting much attention. I've not seen many articles in even tax periodicals that I follow. Certainly not in mainstream media like USA Today, Wall Street Journal, CNBC. I've not seen really much at all on Section 604 and 601 that talk about SEP and 401k Roth employer options. So there you go. I hope you guys enjoyed today's video. It's a lot of fun. Remember, it's a video that drops generally every Wednesday, noon Eastern time. If you miss it, don't worry. If you subscribe, you'll get notified when I go live because sometimes I'll just pop on live at random times if something's breaking. If there's breaking news or updates. Maybe there's a new case law. Maybe there's a new IRS announcement. Maybe I'm just bored and want to talk tax. I don't know, whatever it is. But definitely check out the YouTube channel. It's awesome. I'm really proud of it. So I think you'll enjoy it. Otherwise, reach out if you have questions. If you're a client of IRA Financial and have a Solo K, a SEP, we're happy to chat with you about how these Roth rules could work for you and potentially be a tax planning tool. Although, again, just remember, you're going to have to pay tax on what you get. So that may change people's minds and have an impact. Otherwise, thanks for hanging out with me today. Really appreciate it. And have an awesome rest of your day. Take care.